Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to the video recap that we do here where we go over all of our opening and closing or adjusting trades. But remember, this is just for our members only. So if you're watching this on YouTube, you're actually getting this video about 7 to 10 days after it goes out to just our members. Now, we actually had a pretty active day to start off the week, really, and had tons of new opening orders and then a couple closing orders, which we'll go over here at the end. But the general theme with today's video is that we were selling premium. And that's a really good thing. And you can't shy away from markets like this, right? I mean, stocks were down big time today, just continue to sell off. But implied volatility finally jumped across the board on a lot of things that had not really seen a good jump in implied volatility until recently, namely eBay and AXP and Starbucks and Qualcomm, etc. So that was really, really helpful and just allowed us to, again, use some of that dry powder that we have or some of that leftover capital that we've been saving to invest in some of these things. So we're going to continue. We started today with a lot of small positions. So you'll notice pretty much everything we sold here today was actually a fairly small position, except for Pfizer was a little bit bigger in the number of contracts, but it was a smaller width in strikes. But really the whole idea here is that if we want to add to these positions or continue to add generally positions across the board, that we have that flexibility to do so. So even though the market's down and even though implied volatility is up, we don't want to be too confident in thinking that we've picked the bottom here in implied volatility or even the market. You'll notice that across the board we had calls and puts on both sides of the market today, so, and even in Iron Condor. So we're still trying to be fairly neutral in our underlying assumption for the market. So still trying to trade a little bit more non-directionally, having trades on both sides of the market that allows us to then take profits even if the market goes lower or even if it pops higher. So that's the whole theme with today. I'm going to go over some of these trades in detail. This is going to be a little bit longer video, obviously, because we have a lot more trades to cover. Some of you are like, yes, Kirk, that's great. Let's do a longer video. So stick with me the whole time, and as always, if you have questions, just add them in the comment section right below. All right, so let's start out with Pfizer today. So Pfizer is one that we're getting back into. We've actually traded Pfizer quite a lot in the last 6 months, and it just has really good volatility and it's been moving really well, so hopefully it'll be another winner for us. But we went ahead and we sold the 32.33 call spread, taking in a credit of about 25 cents. So I want to go with Pfizer and take a look at this one today. Here's the chart of Pfizer, so you can see why we had that huge uptick in implied volatility. That's because it gapped lower today. And again, I don't even know what the news is, whatever the case is. Pfizer gapped lower today, so that obviously the stock's been repriced as of the open today. But that gap also created a huge move in implied volatility. So implied volatility is now above the 66th percentile, so leaves us an opportunity to sell some premium. So we went in and we sold the 32.33 call spread, which is right here. That's our first line in the sand. Our 25-cent credit brings our break even to about here, about 32.25 or so. So that's really going to be our major area that we're going to watch. And again, you can see with implied volatility being this high, it gives us a lot of room to be wrong in our directional assumption and still be right overall on the stock. So if we go to the actual trade tab here, you guys can take a look at Pfizer and see exactly where our position is. You can see our position down the bottom of the screen, obviously. Now here's our position in Pfizer. So we traded the 32.33s, so that puts our position right here. And the key with this is taking a look at implied volatility and probability. So the probability of making money on this trade, or the probability of losing on this trade, the probability that Pfizer is in the money ITM by expiration, which is May, so 39 days away, is about 32%. So it's about a 70% chance of success, 30% chance of losing. So again, this is a really good trade and keeps with our directional theme that we're going to have as far as short term, in that we assume the market is going to continue lower until it doesn't. So we want to keep adding positions above the market while also dabbling in some positions that take advantage of possibly a market turn. But we don't want to just load up on the put side and get uber bullish on the market. We also want to be a little bit cautious, and Pfizer is one of those ones today that, since it gapped lower, we're just going to assume that it's going to continue lower until it doesn't. All right, so the next trade that we want to talk about here today is eBay. eBay is actually one that I've had on my radar for a long time, and pricing just hasn't been that great in eBay, really until today. And I've had a bunch of orders I've tried to put in eBay, but honestly, the options, they just don't price that well sometimes with some of these odd strikes, and you don't get the type of premium that you really should receive out of the probability trade you're making. So in eBay's case today, we went ahead and sold the 52.5 50 put spread. So we sold a credit spread. We want the market to go up. We took in a credit of 90 cents on each individual spread that we sold. Again, if we go to the chart here of eBay, you guys can take a look at where eBay is trading right now. All right, so you notice that eBay is a little bit different than Pfizer in that it's not just starting to move lower, but it has been moving lower over the last month and a half. So this is, again, why our directional assumption, which may be different than yours, but it doesn't matter, our directional assumption is, okay, at some point between now and May expiration, we're going to get some sort of a bounce in eBay. Now, implied volatility is just above the 50th percentile, so our strikes are fairly close at 52.5 and 50 today. But again, we think that eBay is going to bounce back up. It's a small position, so we have room to make adjustments or add to the position later on if eBay continues lower. AXP is a very small position that we added as well. This is a credit put spread that we also sold today, and in AXP we sold the 85, 82.5 put spread for 55 cents. So you'll notice that we actually took in a little bit less premium than we did on the same with strikes for eBay and AXP. So a little bit less premium, but our probability level is also slightly higher with AXP. So for AXP, I'm going to go through the chart. You can see again, this is one of those ones that's just starting to move down, but it is at kind of the end of, hopefully the end of a downward move it's had similar type moves before and then quickly rebounded back up. So that's what we're hoping for here. And you'll see that implied volatility is above the 66th percentile. So gives us a really, really good opportunity to sell some good premium here and get away from the market. For AXP, I'll go to this one down below so you guys can see that one as well today. You'll notice that our implied volatility right now, or that our profit and loss right now, we're down about 20 bucks on the stock, and that's because it actually moved down against our position since we actually entered it. So our first strike is at 85, our second strike is at 82.5. The first strike probability of being in the money is actually at 41 right now. So that's actually moved against us. It was around 25 or so when we actually entered the trade. So we were trading with about 80%, or I'm sorry, about 75% chance of success. Right now it's actually moved against us, but you can see that that's pretty evident in that our profit and loss on the day is only down $19 to start the position. But again, we're going to hold this thing as long as we need to. We feel confident that a drop in implied volatility is going to quickly erode a lot of these option premiums. The next one we want to talk about here tonight is Starbucks. So Starbucks is another one that we haven't traded all too often, and that's just because it just doesn't have great implied volatility all the time. But we got another great move in implied volatility for Starbucks. We went in and sold the 67.5, 65 put spread. Took in a credit of about 57 cents, so very similar to what we did for AXP. If we go to the chart here of Starbucks, you guys can see exactly what's happened with Starbucks. Starbucks actually has one of the higher implied volatilities right now that's out in the market, at least the watch list that we have, and it's up at the 71st percentile. So this is definitely one that we want to keep an eye on because we have an opportunity here to continue to add a lot of positions to Starbucks if implied volatility continues to spike like this. Now, we do have our earnings on the horizon, so we know we're going to get a drop in implied volatility when that happens. It's just going to be a matter of understanding where the stock is going to gap, if at all, after earnings happen. It doesn't have a huge history of making big, dramatic gaps after earnings. You can see a number of times that Starbucks had earnings. It just made a very small move, a very normal move, if you will, for Starbucks during the day. So I'm not expecting a huge gap like Netflix or some of these other big name stocks, but that earnings event definitely will see a drop in implied volatility. But again, all we're doing here with Starbucks is playing the fact that it's had a really, really tough month and a half, and we think at some point it's got to give. There's got to be some bottom feeding coming in here. We're coming back on a level that we've hit before in the past with Starbucks, and buyers have come back in and bought up the stock at this point. So that's all we're doing, is making a directional assumption, playing the market here a little bit. At some point, it's got to come back around. We just hope that we're part of that. The next one we want to talk about here today is Qualcomm. So Qualcomm, we went in and sold a call spread instead of a put spread. So in Qualcomm, we went in and sold the 80 calls and the 82.5 and bought the 82.5 calls. Took in a nice big credit of 80 cents. So this was actually a fairly decent sized credit, fairly wide credit that we actually took in, a great premium. If we go over to Qualcomm, you guys can see this is one that we actually haven't traded here on the blog in quite a while. And you'll notice that this is a little bit different than some of the other things that we've traded. So everything else, Starbucks and the like, are all trading lower. eBay are on the end of lower trends. And you'll notice that Qualcomm is actually at the top of a huge move. So this thing has actually had a pretty substantial move up in the last month and a half, which kind of really bucks the trend. So what we're doing here is we're selling a call spread above the market at 82.5, 85. I'm sorry, at 80, 82.5. So it puts our first strike here at 80, and then our other strike that we bought is at 82.5. So giving ourselves a little bit of distance between us and the market. But here's an interesting candlestick pattern. You see that, and we talked about this a couple days ago, but just on Friday, this massive, massive red candle that we had here for Qualcomm just really just kind of put the nail on the head here for this stock. I think that the fact that we had such selling pressure in this security in one day, when it usually doesn't have that big of a move anyway, just really drives home the point that this thing may be turning the corner and starting to head lower. So this is a massive bearish engulfing pattern. You can see if I kind of extend the lines out from both the market open and the market close, that it basically engulfed almost 8 days worth of trading. So that is really, really substantial and puts a huge blow to some of the buyers that already have some securities in Qualcomm. So my expectation is I think this stock will definitely come back down at least into the 75 range if we continue to get some selling pressure. Obviously, that's where it's found good support before in the past. So I'm expecting that to be a pretty decent target. But if we get a drop in implied volatility anytime soon and the stock continues lower, then this position is going to be one of the quicker ones to erode because it just doesn't have high implied volatility all the time. It's very fleeting. It has it once or twice during the year, and this is a good opportunity to trade it. Facebook is one of the bigger names. Now, we already have a position in Facebook for April expiration, so obviously get that out there. We have a debit call spread that we had originally bought in Facebook, obviously keeping that for April expiration. It's still good, positive delta for our portfolio. But again, just like Pandora and Baidu last week, we can't shy away from adding positions for May and treating these as new positions because they're totally a different position. Now, we have to respect the fact that we're still long Facebook, and this makes us even longer net long Facebook because we're selling a put spread, we already have a debit call spread, etc. But for Facebook, we just can't shy away from the implied volatility. So we sold the 50-45 credit put spread for a $1.17 credit. Again, keeping our position size fairly small so that we can at least add to this position if we need to or hedge it, whatever the case is with Facebook. So if I go to Facebook, you can see where our strikes is at 50 all the way down here. So we give ourselves lots of room between us and the market right now. And you'll see that Facebook has had just a really, really tough month and a half, but is coming back into an area that has historically been massive, massive support going forward. So it used to be resistance back here in October of last year and then acted as support 2 times at the end of the year and at the beginning of 2014. And so right now we're back in that same area. I definitely expect at least some sort of support or resistance going through this area if we see some continued selling pressure. Now with Facebook, we do have earnings that's on the horizon for May expiration. So if we do get a jump here in the stock, I don't expect implied volatility to drop too much because as we get closer and closer to earnings, implied volatility is going to stay fairly high, not expecting what is going to happen after earnings. Now, Facebook is one of those ones that's going to jump after earnings, right? If it has good earnings, it'll jump higher. If it has bad earnings, it'll jump way lower. So we obviously need to keep that in the back of our minds, but we could get a directional play here. That's what I'm expecting. I'm not expecting a big drop in implied volatility. I think it'll stay above the 50th percentile all the way until we hit earnings, and then after that, it'll drop off the map. So that's what we're looking for in Facebook, but again, you just can't help but get long some of these things and make a directional bet. All right, so the other trade I want to talk to you guys about tonight is the Iron Condor in Microsoft. I got a ton of emails about this, about how to build this Iron Condor. So we want to go over that in detail tonight so you guys can take a look at it, understand exactly how we build these Iron Condors when we're looking at it. The Iron Condor was in Microsoft, so let's go over that first. It was in Microsoft, and what we did is we sold the 42.44 call spread. So we were $2 wide on the strikes, and then went to the lower side, and that should not say call, but just put, and we sold the 37.35 put spread. So the 42.44 call spread and the 37.35 put spread. Now you'll notice that by matching up the width of the strikes, we make this an even Iron Condor. So it's not unbalanced, it's not broken wing or anything like that. It's a very even, systematic, conservative condor right around where Microsoft is trading. So if we go to the charts here, Microsoft 44 and 37 are our first strikes. That's the numbers that we want to be concerned about with Microsoft going forward. So 37 is all the way down here, and 44 is basically off the map here for Microsoft. I'm sorry, 42 is our first strike here on Microsoft. So 42 is our first strike, which is right about here. So again, a good distance away from where the market is. Now the market's trading right now around 40, so that puts us about even in the middle of the market from where we are right now. Now the reason that we decided to do an Iron Condor is, one, that implied volatility was much, much higher than the 50th percentile. So a lot of times when we sell a credit spread, implied volatility is just above the 50th percentile, maybe into the 60th, but rarely do we actually get stocks that are up here in the 70th percentile. So this gives us a great opportunity to make a wider Iron Condor, which you can see by our strikes, make a wider Iron Condor and give us a bigger window of opportunity to make some money. So that's one reason that we decided to go with the Iron Condor versus selling just a regular credit spread. Now the other reason is because liquidity in Microsoft is very, very high. So it's a highly traded security. Not only are the options, or not only is the stock very, very highly traded, so you can see up here that the volume today was about 37 million shares traded. It's a very, very liquid stock, but also the options have a lot of open interest and a lot of volume. So most strikes that we're trading here have got 11,000, 12,000, 14,000 contracts. On the top side, we've got 14,000, 29,000, 19,000, 8,000 contracts that are open interest. So that gives us a lot of opportunity. The bid-ask spreads become very, very tight for these, which with an Iron Condor makes a lot of improvement in our position. So we have a bid-ask spread that's $1 wide, $1 or penny wide, penny wide, penny wide, 2 pennies wide, all the way across the board. On the bottom side, a penny wide, a penny wide, a penny wide, a penny wide. And these bid-ask spreads are really tight, really, really help us with pricing and premium. Now, before I go into the actual building of it, which I'll come back to this chart here in a second, one question that somebody had here and they sent to me in an email versus posting it on the website, which I obviously love that the best because everyone gets to learn, but they sent to me an email and they said, Kirk, implied volatility is that high. Why not sell a strangle or why not sell a straddle in Microsoft? Now, I could have done that, but this is the only thing I was really concerned about. We have earnings coming up in the next couple weeks. And by selling that strangle or selling that straddle, we open ourselves up to a wider movement in the security at earnings. And so that really is kind of undue risk that we don't want to carry for too long. We're basically going to be carrying a straddle or strangle all the way until earnings. So we're tying up that capital that whole time, then just to see kind of a coin flip move on earnings if it does good or bad or whatever the case is. So I would rather have something that's a little bit more protected and have something like an Iron Condor or even a butterfly at this stage. A butterfly centered right around 40 wouldn't have been bad either. But I definitely don't want to do something that's naked or unprotected with earnings coming up anytime soon. So let's go back here and talk about building this Iron Condor in Microsoft. So we know that on the top side, we went ahead and sold the 42.44. So if you look on our chart here, the 42 and 44s are right here. This is where the strikes are. And we started today with a first strike at the 20% probability level. So that first strike right now is at 23%. today when we entered that trade, that strike was at about a 20% probability. So about an 80% chance that Microsoft trades anywhere below 42 by expiration. And all we did is we went down to the bottom side and then also married up that 20% on the top with a 20% move on the bottom side. Now notice that we didn't just count strikes lower. So we didn't count 3 strikes up and 3 strikes lower. We went for the same probability level on the top as on the bottom. And this gives us an even normal distribution iron condor. So you can see right now that our 37 strike right now has about a 24% chance of being hit. So that was also around a 20% when we entered this trade, but implied volatility has jumped just a little bit since we entered the trade here today. So both of these were right around 20, and that gives us an overall probability of profit at about 60% because we have to add both sides. So if there's a 20% chance it drops below 37 and a 20% chance it goes above 42, we have to add those together. So there's a 40% chance we could lose on one side or the other. And that means that we have about a 60% chance of winning between the strikes. So by having really, really high implied volatility, by having these numbers in hand, we know we've got about a 60% winner on our hands or a 40% chance of being a loser. And this helps us with determining our credit and positioning a strike. So the wider we can make it with these probabilities, the better off we're going to be as implied volatility drops. So hopefully that's really helpful for going over the iron condor. As always, if you have any questions, add them to the comment box below. All right, so the 2 trades that we did close out today were 2 trades that took advantage of the market continuing lower. Now, both of these trades we actually haven't had too long, LinkedIn and the Qs. So today we bought back the 2 short vertical call spreads that we had on in LinkedIn. So LinkedIn, we had sold the 200, 205 call spread. We bought that back today for a 50-cent debit, made $55 on each of those today. Really, you guys know the name of the game with that is that LinkedIn just continued to go lower. We've only had this trade, I think, for a total of 4 trading, not even 4 trading days, maybe 3 trading days. So this is a really, really high return on our investment. We got our money back very quickly and closed the position out. For the Qs, we went back and bought back the 90-91 call spread that we had sold just about a week ago. So I think we only had this trade for about 5 or 6 days total and went back and bought all 8 of these back for a 15-cent debit, which isn't really a big move, but implied volatility has gone higher. So actually it was a really good just directional bet in the Qs. And we made about a $10 profit on each of those, so about $80 round trip. So again, not a huge profit, but obviously just continuing to bank small profits all the way to expiration. And that's really going to help our overall portfolio as we get towards April. We still have a lot of trades left for April, so we're going to continue to exit those trades as we get closer and closer towards expiration. We have a ton of time left in the grand scheme of things here, so it's about 10 days left until April expiration, but you'll notice that a lot of these markets are moving very, very fast right now, so we could easily see a 1 to 2% bump in the market here in the next couple of days, and that will again give us another opportunity to take a lot of trades off, and even some of the trades that we made here today. If we get a 1 to 2% bump up in the market in the next couple of days, we'll have a lot of things that start to decay in profit and implied volatility. In premium and implied volatility, which will then help our positions immensely. So really hoping for a nice little bounce here in the market soon, but even if it continues lower, we've got plenty of powder dry to keep adding to these positions. This is a great opportunity that we have in the market right now to sell premium. So please don't shy away from getting into a lot of positions. This is really, really a good time. You just got to keep your position size small. Don't get overconfident. Don't get cocky in your positions. You want to make sure that you're still keeping your position size small, even position sizes that are about half of what you normally do, so that you leave room to add to that position or increase it or go back in and hedge in a different direction. So as always, I hope you guys enjoy these videos. I know this one was a little bit longer, but it was just warranted the extra time here tonight to go over all these positions. As always, if you have any questions or comments, please add them to the box below. I'll get back to all of those tonight or tomorrow before the open, and happy trading.